2016 was, for lack of a better word, incredible. I mean, we went from a year where I think it was very rocky and markets were not looking great. I think you talk about your note that 1/3 of all global debt with negative yields, to equity markets at record highs and people scratching their heads at all the incredible things that were going on. So tell me a bit about just what foundation was built in 2016 that we're going to be building on for 2017.
Yeah, so if you think, let's start with the economy. We've been talking for years about we live in a persistent low growth world, and I think that was definitely the situation through most of 16, which is why, of course, rates were so low and central banks kept their foot firmly on the accelerator. We had quantitative easing in Europe. Rates stayed low in the US right the way till the very end of the year. And then we had all the political surprises, which created equity market volatility. So, low growth, low rates, equity market volatility, that was kind of the story as we went through most of the year. But then, of course, as we finished with a flourish, I think it'd be fair to say. And there were a couple of things to highlight there. I think the economy exited 16 in better shape than it had been through most of the year, meaning the US accelerated a little bit, Europe accelerated a little bit, China was fairly strong as we went through the fourth quarter. And then, of course, we had the election in the United States, and in the end, the market viewed very favorably the kind of policies that Donald Trump talking about bringing into place.
They're viewing favorably, I guess, the potential policies, because we still don't know at this point what they're doing.
Exactly, yeah.
But I know that I spoke to some folks in your group before, I think when the markets were in the midst of their rally, just showing, for example, even if corporate tax rates were reduced, by how much that increased the valuations in the S&P 500. One thing, though, that you talk about, I think that in one of the notes that you've recently put out, is that we're seeing this theme of rejection of the status quo in 2016, Brexit, the US. How do you see that continuing in 2017?
Well, I think this does bring with it risks. Interestingly, the market drove straight through despite the fact we had Brexit and the election of Donald Trump. Although I do highlight for people, Brexit wasn't a non-event from a market perspective. Stocks in North America were resilient, but of course the British pound did get hit very, very hard and was at a multi-year low. And so in the end, there was a market impact that just didn't tend to affect our clients.
Right.
But if you were
currency trader
or a currency trader, or you lived in the UK and you wanted to travel outside the UK, you would have been hit fairly hard because the pound did went to a very low level.
Right.
But looking ahead, I think this issue of political uncertainty persists, and I think ground zero of it for this is Europe, because Europe has been the area with the slowest economic growth. It has very high unemployment. You're seeing stresses around the issue of immigration, which is a common global theme. And all of these are being given voice by populist parties in the different countries, whether it's Europe or Germany or France. A lot of these populist parties are actually doing quite well in the polls around a similar set of issues. And so I think we'll have to see how that unfolds. But I do think it is a risk in Europe, and I different from what we saw in North America, where we did, kind of look through the election of Donald Trump. I think the central issue for investors in Europe is whether the euro as a currency will survive. Mm-hmm. And I don't think that's a question that will be answered in 2017, but over the next 2, 3, 4 years, I think you could see volatility surrounding that question because membership of the euro has put some countries in a bit of a straitjacket, especially Italy, in my view, where they just have not been able to thrive within the currency zone, and the economy has really, really struggled.
What do you think would be, and I'm going to jump around here a bit, but what do you think would be the implications of the euro not surviving? And I'm not asking you to predict it, although certainly we're seeing, if rejection of the status quo is the theme we've seen, that would imply, I think that's the direction things are going in. But what happens if that gets rejected?
Well, I think from a market perspective, it has to create very, very significant short-term volatility. But in this case, short-term could be, measured in months or quarters as opposed to minutes. Hours and days and minutes as we saw this year, because you can imagine the uncertainty that would come from that. What would replace it? would you have two currency zones, the north and the south? Is it just one country like Italy or Greece exiting the Eurozone and the rest stays in place? So there'd be a lot of uncertainty about what would come next. And I think for any countries exiting, take Italy as an example, you would presumably have their new currency devalued very significantly, which would mean that if you had assets in that country, you would be hit very sharply. So you don't want to be lending, I don't think, to Italy or Greece, for example, because you might end up with bonds that are denominated in some different currency that is worth quite a lot less. So, there's a lot of bridges to cross before we get there, but I do think this is a risk that people need to be mindful of. And it's one of the reasons that we've been relatively cautious on Europe, and we've had a preference for North America in our investing stance in the last couple of years.
Well, then let's focus a bit on North America and just the States and Canada in terms of your outlook for 2017. With the election of President-elect Trump, you highlight and talk about the potential fiscal policies that are coming, the potential tax code changes and trade policies. Let's start with fiscal. Is that all priced in the market already, do you think?
I don't know if fiscal is priced in. I know we're going to get to tax. I think, that's probably priced in a little more. I think the reason I say fiscal is probably not priced in is because there's less certainty about whether it will happen and when it will happen. It almost certainly won't happen in the first half of 2017 because it will require, a budget to be passed. And as we all know, infrastructure takes a long time to get going. I think President Obama once said there's no such thing as a shovel-ready project. And it could be that President Trump finds that out. But it could still have an impact in, say, 2018, 2019. So I think that's more of a longer-term issue about a bit of acceleration in the pace of U.S. growth compared to what we would otherwise have seen. But there's still enough uncertainty around it that I would say it's probably not totally priced in.
Okay, so potentially could see some more upside there. Would that be a fair thing? Okay.
I think that's fair.
Tax code, is that priced in?
I think this is a bit more of this is priced in. So when we talk about taxes, there's two separate, maybe three separate issues we need to think about. One is just a reduction in corporate taxes. So the U.S. has actually very high corporate taxes on a global basis today. President-elect Trump has talked about lowering those very significantly. The numbers we've run is if the effective tax rate was cut by, say, 5%, earnings per share would go up somewhere between 5 and 7%. I think some of this is priced in because in some ways it's the easiest to understand.
Well, I was going to say the markets have rallied, 7 to 8%. So
correct.
Is that,
Yeah, and it's not that mysterious. If you have company A and their tax rate goes down 5%, you, me, and everybody else can figure out what the impact of that is. So it's simple to understand. It's simple to calculate the impact. And both Mr. Trump and the Congress, also controlled by the Republicans, have seemed very committed to lowering taxes. So high probability event, easy to understand, easy to calculate the impact. That's why I think it's more likely priced in. Doesn't mean it's totally priced in, but I think a fair bit of that is priced in. So that's part of the tax. Of course, we also have, sticking on the corporate side, a lot of U.S. companies, particularly global companies, have very significant amounts of cash trapped overseas, we call it, because if they bring it back to the United States, they'd have to pay U.S. tax on it. And so there's been discussion about a sort of a tax holiday if U.S. companies bring that cash back. That could be a catalyst because if a company brings cash back, they could pay dividends, do share buybacks, do acquisitions, things that could create shareholder value. I think that's probably a little less priced in. And then the third piece of the equation is cutting personal taxes. And the question about that is, if we cut personal taxes, will it unleash animal spirits and increase economic activity so that growth is higher? I don't think that is meaningfully priced in because there's lots of economic debate about what the impact of that will be and how quickly it will unfold. And so, taxes is a big topic. I think some priced in, some less so.
What about trade? You have that listed here in terms of another, because that's, I'd say we've got fiscal potential positive. I think tax code already in the markets as a positive. Trade.
Yeah, trade is the most meaningful potential negative, which we've talked about really since the day of the election. And if you think back over the last 5, 10, 20, 30 years, North American companies, generally U.S. companies specifically, have benefited enormously from globalization. Moving production to Asia or to Mexico. You've had whole supply chains built around that, particularly in things like the auto industry, and they've moved production to where costs are lowest. In some cases, they've tried to minimize taxes.
And we're seeing presidential tweets influence even right now.
Correct.
Where things are happening. So
yeah, and so I would say on the trade side, it's a source of meaningful uncertainty right now. But the risk is that rules are put in place, whether it's tariffs or other rules that that kind of roll the clock back in globalization, ultimately raise costs. Those cost increases are passed through to the consumer, and that slows economic growth. So on the one hand, I think fiscal and tax, they could accelerate growth. There is the risk that trade could decelerate growth. The market, so I kind of picture this as a tug of war. The market is clearly looking on the tax and infrastructure or fiscal side and saying that team is winning this tug of war. But you got to remember there is a team on the other side that is pulling also. And we could see some announcements and shocks and headlines as we go through the first half of the year that remind us there is a team on the other side of the rope, and it could create market volatility.
Speaking of that team on the other side of the rope, I mean, one of the things you highlight as well is just the unpredictability of everything that's going to happen, unintended consequences. It was funny because I was I can't remember where I was reading this, but I remember seeing a tweet from a former Mexican president talking about the fact that, well, if you do, ask people not to build as much in Mexico, guess what? You might have some more illegal immigration into the States. Like, there's just things we don't know. We don't know.
Totally. Or you think about the infrastructure program, one of the challenges of infrastructure is going to be who's going to build all this stuff. We want to build roads and bridges and ports at a time when unemployment is actually 4.9%.
So is there slack in the economy?
There may not be. We're pretty close to operating at capacity as it is. So, that's where you'd actually like a little bit of immigration to provide the workers. It may not happen. So for sure, this unpredictability, I don't think we've seen presidents, I'll use the phrase, pick on individual companies before. Ford, you shouldn't do this, or
Boeing,
GM, you shouldn't do that, or Boeing, or United Technologies. So you never know when you wake up in the morning, you could have a stock in your portfolio that is down 5% because of a tweet. And so that is, that's on the other side of the rope as well, I would say.
A bit unnerving, I'm sure, for everyone who's watching. I want to, like I said, paint a global picture, and you highlight the fact that also if you take a look here in Canada, what would you say the dynamics that Canadians need to take a look at? I mean, rising household debt is part of it, and commodity prices. Yeah,
so I think in Canada we've seen quite slow economic growth really for the last few years. And I think as we look out to 2017, we'd anticipate that slow growth pattern will continue, in part because of what you cite there, which is high consumer debt. As you're building the debt, of course, that contributes to economic growth. But if that actually flattens out or even starts to pull back a bit, you're taking away from economic growth. Our view would be the debt in Canada is now at a level where you don't really want it to go higher. In fact, for choice, you'd probably rather go lower a little bit. So, I think that's going to subtract from economic growth. The commodity side, of course, oil is the big one in terms of economic activity. We did see a rally in oil last year, but it did not rally to a level that it would incentivize new investment in Alberta and things like the oil sands. Where really you need probably somewhere between $70 and $80 to justify new oil sands projects. And of course, we're in the 50s now. We're nowhere near the $70 to $80 level. And the concern for Canada would be that with the development of shale in the United States, this new technology that allowed us to get oil out of places we didn't think we could get it before, it's lower cost. And it may be that as oil gets up into this kind of $50 to $60 area, you get a lot of activity happening in, say, North Dakota or Pennsylvania or Texas, and that caps the price because you're getting new supply come on in the $60 area, and we never quite get to the $80 area, which is economic for Alberta. So I think that's, these are long-term headwinds, which is one reason why we believe the Canadian dollar will stay low for a fairly persistent period of time, I think the Governor of Bank of Canada, Mr. Polis, has been fairly clear about this. That's one tool we have to help rebalance our economy, make other things we're doing cheaper from a global perspective through the mechanism of the weak currency, so we can export other stuff to either the United States or other parts of the world.
Which may get trickier too, because at least the exporting to the United States, just given the trade unpredictability that's developing the next little while. Yep. We touched on Europe. I want to touch a bit on China, because I think, have been quite so focused on North America lately. We've kind of forgotten about which country has been driving world growth in the past little while. What do you see 2017 doing for China?
Yeah, well, maybe to start with where we are today, the Chinese government's been targeting growth in the 6.5% area. I'd been saying, if you went back a year or so ago, I thought it was actually growing much slower than that. But as we went through 2016, I would say the pace of growth in China did accelerate quite a lot. We probably are growing somewhere in the 6% area in China today, driven by very aggressive infrastructure spending, financed by the central government, and also by a very hot real estate market, which is starting to result in new homes being built or new apartment blocks being built in the big cities in China. So I think the economy there is growing quite nicely, but the way I think of it is imbalances persist in the Chinese market, and they're reflected partly in the fact that debt is climbing very significantly there as well, both at the household level, which is tied to the real estate boom. We could kind of recognize this from Canada. House prices go up, households take on more debt in order to afford it. That is also happening in China, and also debt at the government level in order to finance this infrastructure boom. A lot of that's actually happening at the local government level as opposed to the central government level. But in aggregate, debt in China has gone up quite a lot. So that imbalance is out there, and that can't go on forever. And so, my sort of medium-term view is that growth will decelerate in China, probably to the low to mid-single digits. Let's call it 3 to 4% as opposed to 6 today. But they can keep it going for a while longer if they choose to.
What does the deceleration of economic growth in China, briefly, mean for trade relationships with the United States? I would just think, does that make it even that's more antagonizing?
Yeah, I think this is a really tough one to untangle. I think I'm not sure I would identify the current trickiness of the relationship between China and the U.S. as directly linked to the growth rate in China.
I don't think so. I was just thinking if it might exacerbate it.
It could. I suppose if growth slows in China, it means there's even less demand for goods from the U.S. to China. But as you know, the big story in that relationship has been the export of very low-cost goods from China to the U.S. And I think the interesting element of that story is if you stopped or slowed that, that does have an impact on lower-income consumers who end up buying a lot of stuff that's produced in China at fairly attractive prices. So in the United States, incomes have grown slowly, but that has at least to some extent been offset by the fact at least you can buy stuff cheaply. If you upset that balance, you could end up with unintended consequences. To
say there's a lot going on in the world would be probably the largest understatement ever. You live in interesting times, and you're managing money at a very interesting time. Let's bring this all back to what sectors look interesting. What you're thinking in terms of where you're overweight and underweight, but let's just start with equities.
Sure.
U.S., I'm assuming the more attractive?
So from a geographic perspective, our favorite market has been the U.S. and continues to be the U.S.
Yeah.
And we upgraded the U.S. Literally the day after the election.
Yeah.
Because of some of the things we've talked about in this conversation. The potential for lower taxes to increase earnings, potential for fiscal stimulus to accelerate economic growth. And we still think that has some room to run. So the U.S. remains our favorite market from a geographic perspective. We're more cautious on Europe for some of the reasons I talked about, some of the political challenges. Although also, look, it continues to grow very, very slowly, which means that domestically oriented companies in Europe are just having a hard time growing their earnings.
Within the States, too, I know you highlight industrials financials, consumer discretionary, IT, looking good. But I got to ask you about valuations, because I mean, yes, they've done well, but I mean, they've had a very nice run in the past little while.
Yeah, look, whether it's those sectors or the market overall, we need to understand the fact the market has run. I said we upgraded U.S. equities the day after the election. Well, between November and December and here early in January, you've had a pretty big move. And so it's not that we're anticipating, enormous returns. We still live in what we think of as a low return world.
Yeah.
We could talk about fixed income later, but in equities, I think, it's probably still right to anticipate that kind of mid-single digit sort of level. If all goes well in the United States and policies get implemented as we've talked about, there could be some upside to that over the next year or two. But the U.S. market trades at something like 18 or 19 times earnings, which is a pretty high level. And so some of this is already in the price. And we wouldn't anticipate that we're going to get the kind of returns that we saw coming out of the financial crisis. Remember in 2009, 10, 11, 12, 13, those were very, very good years in aggregate. I mean, I guess 2011 was a bit of a struggle, but that 5-year period was actually phenomenal for equities. We don't think we're in that same situation today.
And just a couple more quick ones. Canadian equities, you guys are neutral?
We're neutral on Canadian equities. With Canadian equities, you always have to think about the big buckets. Of course, financials, a very important bucket. Phenomenal year last year for financials. Earnings growth was solid. And then you had multiple expansion, and of course you get the dividend along the way. We tend to think that the financials in Canada are just fabulous long-term investments, and they tend to be core holdings in many, if not most, of our portfolios. So we continue to hold them, but after the big move they had last year, you wouldn't necessarily expect outsized returns this year. And then, of course, you get energy and resources, much more cyclical. They did have decent returns last year. I think oil could have a little bit of upside here, but as I said earlier, I don't anticipate necessarily oil going back to that $70 to $80 range. So that doesn't necessarily get you outsized returns in the energy side either. So when we look at the big sectors, it still leaves us at sort of a neutral stance on Canadian equities.
And finally, last one, just on fixed income. You are taking a look here. It looks as though you're pretty much underweight on most fixed income, with the exception of cash.
Yeah, we think there's some optionality in cash. We talked about that unpredictable world we live in. So we kind of view cash as dry powder that you can deploy if you get a bump in the road, and it wouldn't shock us if you do get a bump in the road. So that's the logic behind the cash. Government bonds, our perspective on fixed income is a little like last year. We anticipate low single-digit returns, which in the end is what we got last year, although it was a bit of a tale of two halves. As you know, you actually got sort of mid-single-digit returns in the first half and negative returns in the second half, which got you low single-digit returns for the full year. We think low single digits is about the right expectation for 2017 as well. They still play a role in providing stability to a portfolio, but that long sort of 30-year bull run that we had in bonds where you got capital gains to go with the coupon returns, we think is behind us, and now it's really down to those coupons, which are at that sort of low single-digit level.
Thank you, Bruce.
Always a pleasure.